Hey everybody, Garrett Anderson here from Plan Sponsor Consultants. I wanted to give you a recording of this because I know everyone is so stressed and busy right now. These are very uncertain times, but I'm thankful that you're taking a moment to watch this. I'm going to try and make it brief, but it's a lot of information condensed into what hopefully will be about 10 to 15 minutes. As I'm sure you're aware, on March 27th, in response to this global pandemic, Congress passed the Coronavirus Aid, Relief, and Economic Security Act, commonly known as the CARES Act. That's what I'm going to cover and hopefully give you a good idea of how it affects you and your retirement plan. This legislation, it was created to help keep workers paid and employed, to allow businesses to remain operational, and to make necessary healthcare system enhancements and to stabilize the economy, and hopefully it will help. So this act, we're going to look at how it contains some provisions that specifically affect you and your qualified retirement plan. Let's get started. So it contains a few key provisions, and these are really designed to help employees who might be struggling financially during these unprecedented times. The three big ones are the waiver of premium on early hardship withdrawals, increased loan limits, and a waiver of RMDs. The waiver of RMDs the waiver of penalty on early hardship withdrawals waives the 10% penalty on early withdrawals, if they're taking out before reaching the age of 59 and a half. And this is up to $100,000 out of their retirement plan or IRA. I'm sure you've seen this a million times by now, but when we look at who qualifies, it's really anyone affected by COVID-19. And if that affected your income or your health, we're thinking you qualify. And what we've seen is that a lot of industry sources believe that that's what the congressional intent was to make this relief broadly available to as many people as possible. And likely the IRS is going to operate in kind and take a liberal view of who's actually been impacted. And an important thing to note is that you, as a plan fiduciary and administrator, you can rely on an individual's self-certification that they meet these requirements. So they don't need to provide anything. You don't need to check on anything. If they say they qualify, process their distribution or loan request. When it comes to hardship withdrawals, they're still subject to income tax, but that tax can be paid over a 3-year period. Also, the withdrawals can be paid back over a 3-year period and avoid taxes altogether. And these repayments are kind of treated as a rollover contribution and are not going to be subject to annual maximum contribution limits. So if they take $50,000 back or take $50,000 out and then put that $50,000 in, that does not go towards their personal maximum contribution limit. And when it comes to the taxes, they can be paid over a 3-year period, or the individual can elect to have it paid in the year of distribution. When it comes to loans, the Act doubled the loan amount from 50% to 100% of an individual's vested account balance, and from up to $50,000 to up to $100,000. And these increased loan amounts are available during the 180-day period beginning on the date of enactment. The Act also extended the due date of any qualified loan repayment that would otherwise be due in 2020. And when I mean qualified, I mean anyone who qualifies under the COVID-19 requirements. And they extended it to 1 year after the otherwise applicable due date. So if someone says, I want to extend the due date of this loan and I self-certify that I qualify, they now can extend it to 1 year after their typical due date. And these loan distribution qualifications are the same as hardship withdrawals. So if it's Corona related, they qualify. But keep in mind, it's very important to review your current plan features. You want to look at your in-service distributions. Some plans permit in-service distributions once participants reach age 59 and a half. Other plans don't. meaning you'd have to retire and take your money out to get that distribution or be terminated. Your hardship distributions. So some plans permit hardship distributions. Most of our plans that we work with definitely permit these. And these are giving employees access to their money under immediate and heavy financial need, including medical costs, payments to prevent eviction, foreclosure, et cetera. And of course, the COVID-19 pandemic qualifies. And then loans, not all plans offer loans. Some plans offer multiple loans. You want to review this, certainly. Now, if you do want to make the plan amendments and adopt these provisions, you can if you want to, but you're not required to. And if you want to, you can adopt them immediately. And I would recommend calling your record keeper and looping us in to start that process. The plan amendment deadline for adopting these new rules would be no earlier than the last day of the first plan year beginning on or after January 1st, 2022, or later as prescribed to the Treasury Secretary. So you got time to do the amendments, even if you want to adopt them immediately. We do not need to make the amendment immediately upon adoption of the new provisions. Now, if the plan does not expressively provide for loans and distributions, which is why I mentioned we should look at whether your plan does or doesn't from at the beginning of this, you can generally amend the plan at any time to permit these. So if you want to incorporate the new provisions, well, first you have to make loans and distributions available from the get-go. So we can do that at the same time. And you may also be able to expand the availability of distributions or loans already available under your plan. But of course, we always recommend you should seek legal counsel to ensure that any expansion is permitted under the law. And of course, get your TPAs involved as well. For example, regarding expansions and loan repayment, when we look at furloughed employees, applicable tax laws permit suspension of planned loan repayment for up to 1 year, and the loan can then also be re-amortized over the original term once the employee returns to work. So there is some flexibility there for furloughed employees. Now let's talk about RMDs real quick. The CARES Act suspends RMDs, required minimum distributions, during 2020. This applies to both retirement accounts and their beneficiaries taking distributions. Not only that, the CARES Act eliminates RMDs for 2020, but any RMD that otherwise needed to be taken in 2020, meaning if that you needed to take your 2019 one, but we're going to take it in 2020, you don't have to take either your 2019 or your 2020 RMD. And any individual who already took their RMD for 2020, they can roll it back into the plan without any consequences. When it comes to DB plans, the Act delays the due date for contributions otherwise due in 2020, and they give you a year for this up to January 1st, 2021. At that time, contributions are going to be due with interest, and that the plan status for benefit restrictions as of December 31st, 2019 will apply throughout 2020. And if you have more questions on this, please let us know. When it comes to other relief, we're hoping to see some deadlines pushed and to see some extensions. But as of March 31st, we have not seen any extensions for filing requirements given yet. Of course, we will communicate any extensions as soon as we know about it. And these would be for things like an automatic extension for your 5500. Or an extension to the deadline for correcting a failed ADP or ACP test, or distributing excess contributions and excess aggregate contributions under a plan. Things that have hard deadlines. We're really hoping that the DOL will postpone some of these deadlines to give us a little relief and time to get things together. And we will certainly let you know as soon as we know. So I want to switch gears real quick. A lot of you may or may not be looking at reducing benefits, and one of those benefits might be the employer match, whether it be non-discretionary or safe harbor or profit sharing. So if you are considering that, please reach out to us and we can help you with the calculations to really see the dollar amounts and and play with what your bottom line might be to help give you the best option, because it's not always the easiest thing to do. So let's look at that real quick. For non-safe harbor plans, you have a lot of flexibility to reduce or discontinue matching or non-elective contributions. Generally, non-safe harbor plans, if you specify a certain matching or non-elective contribution formula, that can be amended at any time to reduce or suspend your contributions. Although participants are still entitled to any contributions that they've earned under the terms prior to any amendments made. So if you do want to do this, you want to do it sooner rather than later. For plans that permit entirely discretionary employer contributions, a plan amendment may not even be necessary, although it's important to document that. For example, a formal employer approval, committee consent or board consent, et cetera. It's always good to document everything, especially during these tough times, so that the DOL doesn't think we made any rash decisions. On the other hand, safe harbor contributions, they can actually be suspended only if you're operating at an economic loss for the plan year, or if your annual safe harbor notice that you provided to participants at the, before the start of the current plan year contain a disclosure that specifically talks about how you might reduce or suspend the safe harbor contributions. So if this is your safe harbor and you want to suspend or reduce these contributions, let's pull that safe harbor notice from the get-go and we'll start there. To suspend or reduce safe harbor contributions, you must also take the following steps. Like every change in a retirement plan, you got to provide a notice to employees at least 30 days before the change is made, explaining that the contributions are going to be reduced or suspended. You must amend the plan to provide for the reduction or suspension of these contributions prior to the effective date of the change. And obviously, you're still obligated to pay any contributions earned prior to the effective date. And because the plan will lose its safe harbor protection for the current plan year, should you do this, you're going to then be required to perform ADP, ACP, and top-heavy testing for the plan. And this will have, it could come with adverse consequences and will have an additional cost to it. So, if we're worried about reducing employer contributions, you're probably also, looking at the workforce, potentially implementing a furlough or layoff, and it's important to consider what the plan implications are. There are some potential issues and costs that could arise. I would recommend consulting some legal counsel should this be going on right now in your organization, but let's take a closer look at how it affects your retirement plan. So as you know, a furlough is, it's not considered termination of service. They still accrue vesting, service, and additional benefits under the plan. So it's important to review your plan provisions regarding service when considering a furlough or unpaid leave. On the flip side, if you're making layoffs or reductions in your workforce, you should note that this could become an involuntary turnover of 20, if it becomes an involuntary turnover of 20% or more, that it creates a presumption that there has been what's called a partial plan termination. And a partial plan termination, when that happens, all impacted employees become fully vested in their entire account balance. And this includes all employer contributions, regardless of the vesting schedule. So if you have a very generous match, but a 6-year vesting schedule, if an employee only has 2 years into that vesting schedule, they're going to get the full account balance, and the vesting schedule will not apply to them. Another really important thing to look at right now is depositing of employee contributions. So I know we're all kind of in flux right now, and you're probably having to adapt to employees working remotely. You're probably operating under tightened budgets, potentially implementing a furlough or layoff, and that puts a lot of stress on HR. But one thing you need to make sure that you consistently stay on top of is depositing employee contributions. You want to keep this in a timely manner and keep with your current schedule. So if you deposit them 2 days after payroll, make sure you continue to deposit them 2 days after payroll goes out, because this can become a big issue. And the main reason is because those are considered plan assets as soon as they can be segregated from your general assets. And failure to timely separate them and get them deposited and invested for those employees could result in excise taxes, penalties, and additional costs to you as the employer. Also, to the extent any leave of absence is paid or partially paid in the event of layoffs, you're doing them a service by, partially paying them and, keeping their income flowing. But you should be mindful to properly apply the plan's compensation definition for purposes of employee deferrals. So you want to be in line with that. For example, paid time off is generally considered plan compensation. That if they can contribute during this period, but they cannot contribute during severance. So severance pay is not considered plan compensation. Also want to highlight one other area where it's crucial to maintain fiduciary focus, and that's your investment lineup. This is a primary role of ours, is to make sure your investments are performing properly and suitable for your employees. We want to make sure that you continue to review and monitor all of your investment options under the plan. We're continuing to monitor them, and we will certainly make sure to raise any red flags and make sure that you're aware of anything going on that we want to be mindful of. I also want to make sure that investment fiduciaries and committees are still meeting. We have teleconference and video conference available. We're meeting with committees. We're staying on top of things, and we want to be mindful of your time, but make sure we're still on top of our fiduciary responsibilities. So, if you meet annually, right now it's probably not a good time, but we can certainly meet later in the year. If you meet semi-annually, we're here, we're available, and we want to make sure you're still meeting with us semi-annually. And certainly if you're meeting with us quarterly, we want to get that committee together for, even if it's a 30 to 40-minute meeting, we want to make sure we're reviewing things. And we will have first quarter data by the 15th of this month, and then our reports will go out, and that's when we really will ramp up and start meeting with you all to make sure that our investments hopefully did what we wanted them to do. So please contact us with any questions regarding the CARES Act or investments, employee education. That's what we're here for. We're rolling out employee webinars. We're helping people cope with the market volatility and making sure they understand that we invest for the long term. Retirement plans should expect some volatility. Obviously, this is unprecedented, but we do hope for a rebound, and we want these employees to be positioned for a recovery. So we're still trying to meet with as many people as we can. We're going to be rolling out a couple events, webinar events that everyone can tap into, and we hope you will promote them. But if you want us to put something up specifically for your organization to help calm the nerves and help keep people invested and focused on the long term, please let us know. That's what we're here for, and we're here to help. So I wish you well, and I hope to see you all soon, and we look forward to the future. Thank you.